Welcome to the Economic Bulletin. I'm Hani Saif. We will present comprehensive coverage and expert insights on key updates regarding pivotal economic trends and financial trends. Welcome back. We'll start off with the United States, where the final jobs report before the election offers a mixed view of the U.S. economy, revealing just 12,000 jobs added in October. This figure falls significantly short of September's impressive 223,000 and the anticipated 112,500. Economists had warned that recent hurricanes and ongoing labor strikes would impact the numbers. The unemployment rate remains steady at 4.1%. This report is considered the last major economic data release ahead of Election Day. In Europe, British house prices saw a sliding increase of 0.1% in October, a significant slowdown from the 0.6% rise recorded in September. Despite this declaration, the market showed resilience and is expected to gain momentum as borrowing costs decrease. Year on year, prices were up 2.4%, which is lower than the 3.2% increase observed in September. British Prime Minister Keir Starmer has emphasised the need for the governing Labour Party to make responsible decisions to address the UK economy. Starmer stated that they have made tough choices, adding that many people recognise the importance of focusing on health, education and housing.
We've had to do what is responsible to fix the foundations and rebuild our country. As I think is now well understood, we inherited a £22 billion black hole, money that wasn't accounted for by the last government. I'm not prepared to simply walk past that. We have to fix it. So we've done the responsible thing. The principles that we put in place are to stabilise our economy and to invest in the future along with reform.
Still on the UK budget, as rating agencies have assessed the new Labour Party budget, with the S&P Global Ratings warning of a constrained fiscal position due to high budget deficits and government debt. They noted that public investments in healthcare and infrastructure could improve the business climate and boost economic growth. Moody's echoed these concerns, stating that increased borrowing poses challenges for public finances, as gilt yields have reached their highest levels this year following just proposed 28 billion sterlings in extra borrowing. Moody's believes the budget will have a limited impact on growth and emphasized the need to address structural constraints for investments to enhance growth potential. On another note, Hungarian Minister of Foreign Affairs and Trade, Peter Szijjártó, said that the European Union's decision to impose higher tariffs on electric vehicles from China is harmful to the European economy. Starting Wednesday, the imposition of anti-subsidy tariffs on Chinese-made electric vehicles will remain in place for 5 years, with rates varying by company from 17% to 35.3%. among China's leading automakers. Szijjártó expressed concerns about the EU's move, saying it will weaken the bloc's competitiveness. According to data released by Switzerland's Statistics Office, Swiss inflation dropped to its lowest level in over 3 years in October. This decline suggests that the Swiss National Bank may implement further interest rate cuts this year and into 2025. Consumer prices in Switzerland increased by 0.6% in October compared to the same month last year. According to Federal Statistics Office data, this marks the smallest price increase since July 2021, driven by lower costs for food, clothing and household goods. Data from the Australian Bureau of Statistics showed that the household spending fell in September. The Australian Bureau of Statistics monthly household spending indicator revealed a seasonally adjusted decline of 0.1% in September compared to August, which saw a rise of 0.2%. This decline comes as a surprise to the Reserve Bank of Australia, which had expected consumption to increase in the latter half of the year. Consequently, the bank may adopt a more dovish stance in its upcoming policy meeting. Additionally, the data indicates that annual growth has sharply slowed to 1.3%, down from 2.7%, marking the lowest rate since 2021. Moving on to Asia, Japan's government has revised its GDP growth forecast for the current fiscal year, citing weaker exports that are hindering the fragile economic recovery. The Cabinet Office lowered its inflation-adjusted growth estimate from 0.9% to 0.7% for the fiscal year ending in March 2025. The adjustment follows a previous downgrade in July, but remains higher than private sector predictions of 0.5% growth. The growth projection for the following fiscal year remains unchanged, 1.2%. Moreover, Japan's central bank has said in a report that the country's increasing minimum wage is expected to drive inflation, particularly by raising services prices. The central bank identifies sustained and widespread wage increases as a key condition for raising interest rates from their current near-zero levels. The bank noted in its full quarterly outlook report that the average minimum wage is set to rise by a record 5.1% in the fiscal year ending March 2025, with significant increases in regions where wages have traditionally been lower. South Korea's export growth slowed to a 7-month low in October, falling short of market expectations. Official data revealed that South Korea's exports rose 4.6% year-on-year to $57.52 billion, marking the smallest increase since March and a slowdown from the 7.5% gain recorded in September. On a per-working day basis, exports declined by 0.2% compared to the previous year, representing their first decrease since September 2023. Official data released that Indonesia's October headline and core inflation rate slightly exceeded expectations. The October headline inflation rate was 1.71%, down from 1.84% in September. This marks the lowest rate in 3 years, continuing a steady decline since March. Core inflation, which excludes government-controlled prices and volatile food items, rose to 2.21%, the highest level since July 2023, driven by increasing gold prices. According to the International Monetary Fund's Regional Economic Outlook for Asia and the Pacific, Asia's short-term prospects have improved slightly, with 2024 growth projected at 4.6% up from 4.5%. The region is expected to account for about 60% of global growth. For 2025, growth is revised to 4.4%, supported by more favorable monetary conditions. While inflation has eased, risks from geopolitical tensions, global demand uncertainty, and potential financial volatility have increased. Demographic changes may hinder growth, but shifts to high productivity sectors like tradable services could sustain robust economic performance.
The International Monetary Fund (IMF) has raised its growth forecast for Asia, expecting the region to expand by 4.6% in 2024 and 4.4% in 2025, bolstered by looser global monetary policies. However, the IMF cautioned that escalating trade tensions, especially with retaliatory tariffs and issues in China's property sector, could pose risks. The report emphasized that ongoing volatility might undermine consumer confidence and investment if economic conditions fail to stabilize. Meanwhile, as China faces growing economic challenges, other Asian countries are closely monitoring Beijing's efforts to stabilize its economy, according to a recent Wall Street Journal report. If China's economy fails to achieve stability, the impact could spread across the region, potentially slowing recovery for economies just starting to rebound from the pandemic and successive global crises. For 3 decades, China has been a key engine of growth in Asia, driving trade and investment. However, economic pressures slowed growth, rising debt, and waning consumer confidence have raised concerns among neighboring countries about China's ability to return to its previous growth trajectory. Meanwhile, Asia faces significant climate challenges, according to the Asian Development Bank (ADB). Climate financing needs in Asia range from $102 billion to $431 billion annually, far exceeding current funding levels. The ADB warns that without increased adaptation measures, rising sea levels and extreme weather could cost the region $3 trillion yearly and reduce by up to 17% by 2070.
And joining us today to discuss the latest economic developments in Asia is Mr. Meher Nicholas Fursley, the director at the European Asian Centre and former advisor to the World Bank. Welcome to the show, Mr. Fursley. Now, the IMF revised its Asia economic growth outlook to 4.4%. Now, in your opinion, what factors contributed to this projected downfall?
I'm delighted to join you today on Al Qahira News English. I wouldn't use the word downfall, and I think the choice of word here in the IMF itself, I think, is using strong words, and I think downfall is too strong. I think it's a minor revision, so it happens all the time. You could call it a routine revision because, after all, last week there were the annual meetings of the World Bank and the IMF in Washington, D.C., which last the whole week, and it's traditional, it's normal that economists in the days leading up to the IMF World Bank meetings, they always adjust. So the adjustment they made, honestly, is a reduction of 0.2%. So it's a minor adjustment. Still, Asia, so to use the IMF's own words here, Asia will remain the world's growth engine next year, which is great. It's slowing down a little bit, and that's Asia in general, the whole continent, right, which is a gigantic continent. And China also, which itself represents, so to make a long story short, why is Asia the world's growth engine? Because it represents 60% of the world's net real growth, which is really phenomenal. And inside that 60% of the world growth coming from Asia, 60% comes from China. And the IMF also revised a little bit downward China's economic growth, and now they expect the country to grow by 4.5% next year, citing potential setbacks, including trade restrictions from America and Europe, and an expected slowdown in domestic consumption, and that festering real estate construction crisis, which we have seen in China. So I think what the IMF did, they lowered a little bit Asia in general, remaining optimistic for next year. And they also reduced China, and they said that they were not that optimistic on China. So that's the distinction, I think, made by the IMF.
Mm-hmm. Then how do these revised projections or predictions compare to other regions globally?
once again, quite well, because the revisions that the World Bank and IMF and OECD did in the past week on other continents were far more drastic. So, people have been revising downward the economic growth prospect of England, Britain, France, Germany, Italy. So the rest of the world is really slowing. Europe in particular. So in economics and finance, everything is relative, right? Nothing is absolute. So we're happy about Asia, even if Asia is slowing a little bit because it is still growing much faster than the rest of the world. In particular, Europe. Europe seems to have entered a slow growth, a protracted corridor, and that's very worrying. So I'm very worried personally about France, Germany, Italy, the big components or big parts of the European Union, because if France and Germany and Italy are slowing down, the whole of the European Union will slow down mechanically because other European Union economies are small, and the UK is trying to relaunch its economy by pursuing original policies, but it will take time. So in the short, medium term, the news coming from London is not great. So when you have all these big European countries inside and outside the EU slowing, it is not good. So investors look for growth, future growth, and they still find in most of Asia and the Middle East, they still find attractive growth prospects.
Mr. Fawzi, now speaking about other regions, the IMF report also mentions that Asia brought inflation down faster than other regions, the European Union, the UK. Now, what strategies have been effective in achieving this?
Probably printing less money, to be honest, because to be really blunt, I think the European Union and to a lesser extent Britain and America have been reckless in what they called quantitative easing, which is a fancy word for printing a lot of money and keeping interest rates at artificially low level for abnormally long periods of time. The Asians have played the same game, but they have played it less, I guess, less abusively or in a less pronounced way. So the central banks in Asia have been more cautious. It's very good. Or more cautious or less complacent than European central bankers, which in relative terms is good. Then you have savers and consumers. I think the middle class, the bourgeoisie, the rising middle class in countries like Indonesia, Malaysia, India, which is starting to be quite large. They've been saving a lot of money, but consuming reasonably. So they haven't borrowed, consumers in Asia don't borrow as much as consumers in Europe and America. Companies in Asia don't borrow as much. That is also helping on the inflation front because, the more leverage you are, the more borrowing you do, the more sensitive and fragile to inflation you become.
Yes. Well, to what extent is the real estate crisis in China affecting the investor confidence? And do you think that this can create some sort of a ripple effect across other Asian economies?
Yes. The short answer is yes. I mean, that's the $1 billion question, because that crisis has been like a slow motion crisis. You can almost watch it on video slowly. So it really started 2.5, 3 years ago, and it has been developing slowly. And one of the reasons why it's a slow motion crisis is, to be honest, China is not really a free market economy, which is both good and bad. Because in a purely perfect free market economy, the crisis would have been much, much more brutal, but it would have lasted a shorter time. Because in China, the central government gets to decide a lot of things. That big bullet, they've been trying to bite the bullet, and so far they haven't found the magic way to solve the problem. So we had that every quarter, every semester, the crisis comes back to haunt the Chinese government and Chinese policymakers. They haven't resolved it. They're trying to fix it. So 2 or 3 weeks ago, they started using some macroeconomic tools. One of them is to print more money, for example. to bite the bullet, to lubricate the economy, etc. It's not enough. So you have big companies, big banks, not only real estate and construction companies, because if it was only real estate and construction companies, the crisis would be limited, right? The problem behind construction and real estate and infrastructure, all the big state-owned Chinese banks on their book, they have bad real estate, bad property-related loans. So if and when there's a full-blown crisis, it will hurt a lot.
Mr.
That's the
Mayor
big threat.
Nicholas Fursley, the director at the European Asian Centre and former advisor to the World Bank. Thank you very much, sir, for your input. And now we move to the MENA region. New Zealand has reached a trade deal with the Six-Nation Gulf Cooperation Council that Wellington said would open up major opportunities for Kiwi exporters in the Middle East. New Zealand Trade Minister Todd McClay said that the trade pact would remove tariffs for 51% of New Zealand's exports to the region from day one and deliver duty-free access for 99% of New Zealand's exports over 10 years. McClay said that successfully concluding a trade agreement with the GCC has been a long-standing ambition for successive governments for almost 2 decades. The United States has warned that Israel's decision for a month's waiver extension on cooperation between Israeli and Palestinian banks covered a very short term and would create another looming crisis by November 30th. The remarks came after a spokesperson for Israeli Finance Minister Bezalel Smotrich said that he would sign the waiver to extend banks' cooperation for another month after the cabinet agreed. U.S. Secretary of State Antony Blinken and Treasury Secretary Janet Yellen urged Israel to extend the banking relationships for at least a year to avert an economic crisis in the Israeli-occupied West Bank, warning that its own security was at stake.
Work together to help emerging markets in developing countries facing debt distress. The issue of global debt is not a bilateral.
Israel's cabinet is voting on strict austerity budget to address soaring defense costs stemming from the ongoing war on Gaza and Lebanon. The budget includes 40 billion shekels in cuts and tax hikes. The budget outlines 40 billion shekels in those cuts and tax hikes include raising the value-added tax to 18% as part of fiscal tightening measures. Prime Minister Benjamin Netanyahu emphasized economic restraint, stating there is no economy without restrictions. The budget allocates 102 billion shekels for defense out of a total 744 billion, aiming to reduce Israel's deficit from 8.5% to 4% of the GDP. In the stock markets, the global stocks had a mixed performance amid last major U.S. economic data release ahead of Election Day. In the United States, the S&P 500 went up by 1.1%. The Nasdaq Composite traded 1.5% higher and the Dow Jones Industrial Average went up by 1.3%. In Europe, France's CAC 40 added 0.4%, Germany's DAX gained 0.2%, and Britain's FTSE 100 traded 0.4% higher. In Asia, Japan's benchmark Nikkei 225 sank 2.6%. Hong Kong's Hang Seng Index added 0.9%. The Shanghai Composite Index slipped 0.2%, and South Korea's Kospi traded 0.5% lower. That's all for And here's a roundup of today's key economic headlines. The U.S. non-farm payrolls rise by 12,000 in October. Rating agencies raise concerns over the UK's new Labour Party budget. And the IMF expects Asia's economy to expand to 4.4% in 2025. That's all for today's Economic Bulletin on Q News, but stay connected for more news and updates. Don't forget to follow Q News on YouTube, Facebook, X, Instagram and TikTok at QNewsEG to stay informed. And for real-time updates, connect with us on the UMS digital platform. Watch it. I'm Henny Saif. Thank you for joining us.